So going forward, there are two key institutions, if you want, or levers that are impacting what's going to happen. First is the Bank of Israel. The second is the government of the State of Israel. So what's the Bank of Israel, your alma mater, been doing to try and make sure we steer through these choppy waters?
Yeah, so I'll say a few words about what the Bank of Israel has been doing to sort of help mitigate the effects of the war on households and on businesses. So I mentioned already the foreign exchange intervention and the willingness to intervene, so I'll skip that. And I'll only mention the programs to defer loans, especially for victims, family, people around the border, and reservists. So there are all these programs. Some of them are still going on, or of basically alleviating the need to actually service the debt. And that's true also for small businesses. At the initial stages, early on during the war, there was also an instruction by the banking supervisor for banks not to issue dividends, so as to make sure that they have enough capital to be able to continue actually providing credit even if things get worse. Since then, I think banks have been doing very, very well. So the distribution of dividends resumed. But I would say generally that the fact that banks here are very well capitalized, and we have a very conservative supervision, makes it possible for them to actually take all these steps and continue providing credit and providing relief in terms of credit during period of stress. So I think in that sense, they played a very positive role. Looking forward, so this is just taken from the latest Bank of Israel announcement on the 6th of January. So this is what, the projections. These are the projections by the research department. They expect an inflation rate for the 4 quarters ahead of about 2.6%. You can see that it's within the range of between the capital market and private forecasters. And they talk about 1 or 2 interest rate reductions during the year, which is, I guess the market is slightly more optimistic. They're expecting 2 and maybe slightly more than 2 reductions a year. I think according to the announcement by the Bank of Israel, they continue placing quite a lot of weight on stability, on stabilizing the market, although now it seems that at least in terms of the main market, the foreign exchange market is quite stable. And in fact, the strengthening of the shekel, I think, will make it easier for them to reduce the rate. And also, I think there are signs, as I mentioned before, of lighter supply constraints. And if these constraints are continued to be eased, I think it's quite likely that we will start seeing inflation coming down and will allow the Bank of Israel to reduce interest rates, maybe getting towards the middle of the year. But yeah, that's sort of what I think is a reasonable expectation. So that's in terms of monetary policy. What about fiscal policy? I think here there is quite a lot of drama, I would say. We started the government, we entered the war with a debt to GDP ratio of 60%, which allowed the government to increase spending dramatically with some increase in prices. We've seen the increase in risk premium, but there was no difficulty to finance. But the question is, what is the burden that the costs of the war and the increase in defense spending means going forward? So we ended the year relatively okay with okay, given that we've been in a war, with a 6.9% of deficit to GDP. Okay, this graph is taken from the Ministry of Finance monthly report about the government finances, and each bar shows what is the deficit in the last 12 months. So actually in September, when you looked back for the last 12 months, the deficit was at 8.5%. It included the huge costs at the beginning of the war. When you move forward, some of these months are already out of the calculation of last 12 months, and we ended the year 24 with a 6.9% deficit, very large, but we see some diminishing of the deficit. And the government target for next year is a deficit of 4.4%. I should say that 4.4% is much higher than the level of deficit that will stabilize the debt to GDP ratio. So what we're going to see, we already saw in 24 a jump in the debt to GDP ratio to 69%. That was published, I think, 3 days ago, something like that. And we're going to see a further increase in the debt to GDP ratio in 2025. I would say this is the most important, in terms of the public finances, this is the most important figure. And I think the market will be watching to see whether we start seeing a beginning of a decline in the debt to GDP ratio. I should mention, in 2020, during COVID, you can see that deficit went through the roof to 11%, but it came down very rapidly, and the debt to GDP ratio, which jumped to over 70%, went back to 60% because of the relatively rapid decline in the deficit and a very strong growth of 8.5% in 2021. I don't expect to see that going forward, partly because the deficit is expected to continue be quite high because of the mostly because of the additional defense spending. One positive sign is the fact that actually tax revenues continue to go up according to trend. And you can see that actually direct taxes, which are taxes mostly on income tax and on profits, they're actually above trend. Taxes on indirect taxes, which are mostly on consumption, are slightly below. But overall taxes are actually booming, which helped limit. We think that the deficit has started going down, and it's partly because of the booming taxes. So that's the sort of positive development in terms of the public finances. When we think about going forward, when we think about fiscal policy, there are a few things that we should bear in mind. It's just a reminder. One is we have, of course, very high spending on defense. This is Israel 2023. It's going to go up further. And we have very, very modest civilian spending on education, health, infrastructure, and so on, is relatively very modest in Israel. So I think it's important to bear in mind when you think about the government fiscal policy going forward that where we are in those two areas. By the way, the defense spending, again, looking back, when there was always a discussion between the Ministry of Defense and the Ministry of Finance regarding defense spending. And the numbers that the Ministry of Defense would always show would be these numbers. The defense spending relative to GDP has been going down for many years. The Ministry of Finance would always show these numbers, which is in real terms, defense spending has gone up quite significantly. And this is, I mean, we're now at the point where the question is, where is defense spending going to go? I think the Ministry of Defense would like to fix it in terms of as a proportion of GDP. That is not going to happen. But this is just to sort of get the sense of where we are, where we were. When you look over a long period of time, actually the decline in the defense and interest on government debt in terms of GDP were translated into lower debt and into lower overall spending. They were not translated into higher civilian spending. And so I think the challenge now is if you have, again, higher defense burden, how you're going to finance it. It's going to be very hard to finance it by further reducing civilian spending, because as you've seen in two graphs before, the civilian spending in Israel is very, I would say, stingy. And it's going to be hard to sort of reduce it further. Okay, overall spending on defense during 23 to 25 is about 272 billion. And I think more important is where are we going in terms of the defense spending forward. And this is a chart based on the Nagel Committee recommendation. I think the bottom line is that according to the Nagel Committee, which gave a recommendation, but I think it's going to be followed, the overall defense budget is going to go up by 270 billion shekels over the next 10 years, which is an increase of about 2.7% of GDP each year, okay? So it will be, you'll have to somehow finance it. And one of the things that the Nagel Committee actually failed to do is, and they were requested to do according to the terms of reference, is to identify sources for this additional spending. It's not part of the current budget plan. It means probably higher taxes. It's going to be very hard to reduce, as I said, civilian spending. So that's a very significant challenge going forward. 25 budget. It has not been approved yet. As you know, the government has until the end of March to approve it. If it's not approved, the government falls. So there are efforts now to sort of get it through by the Knesset. What has been approved so far are the tax measures that are actually listed here. So the main tax measures in order to reduce the deficit for 2025 are the taxes on undistributed profit. Are you familiar with the term? Okay. And that's supposed to yield over 9 billion shekels. There is the public sector wage cuts, which is part of the budget. It's not on the revenue side, so it's still in discussions until the budget is approved. We have an increase in the Social Security tax and the freezing income tax increase. This is actually freezing of the tax brackets. You know, the tax brackets here are normally, I mean, by law, they are indexed to inflation. So there was it's virtually an increase in taxes. And I think the overall package here, if the budget goes through as planned, which it has not yet gone through, the deficit is going to be, as I showed before, around 4.4%. However, there is an additional spending already recommended by the Nagel Committee, which is not here, about $6 billion for 2025. So that, again, would need to be financed. Very substantial measures, and that's only for 2025. When we think about the budgets going forward, they will have to come up beyond all these measures with additional about 27 billion per year, yeah, roughly, which is very substantial, very challenging. So what hasn't been done? I mean, I've shown here the budget plan as it is. There are some pieces that I think are missing from that budget plan. You know, I think I talked about the coalition funds, the coalition budget, which is basically mostly for the ultra-Orthodox, for their education system. There was a very partial cut in those resources in the 25 budget, and there are all these superfluous ministries that have not been shut down, in spite of an intention to shut some of them down. I have to say that these two would not yield huge amount of resources, but I think are important to sort of increase the trust in the way the government runs its business in the current difficult circumstances. I talked about the security, additional resources. I have to say that one of the troubling, I think, things regarding the Nagel Committee was that there was no discussion of what is the basic scenario for which the defense budget needs to be to meet. What are exactly the challenges that it needs to meet? They worked very condensedly in a very short time, so that's an issue. They didn't identify resources to offset the additional defense spending. And also, one of the things that the government in its proposal does is basically have flat cuts, and it has very hard time to actually identify or make a change in its priorities. And the easiest thing when you don't want to sort of get into discussion with specific interest groups is to have a flat cut. It's not the most efficient, but that's what governments tend to do.